Hi, everyone. Thanks for joining today's Acuma Inside Track webinar. Appreciate you spending part of your day with us. We will wait just a minute or so to let some other people join, and then we'll get started. Okay, let's get started. So first, I'd like to send a huge thank you to Peter and Krista and everyone at Acuma for organizing today's Inside Track webinar and for inviting me on to talk about servicing with a purpose and a focus on compliance within residential mortgage servicing. So first, let me introduce myself. I'm Scott Weintraub. I'm the Vice President of Compliance at Mortgage Quality Management and Research, which is a mouthful. You can all refer to us as MQMR. And we're a company that provides help to credit unions like yourselves and to banks and IMBs as well, anyone that makes a mortgage. And we help folks with all things compliance, risk management, and audit related. So really excited to be on with you today, and let's take a look at our agenda, and then we'll dive right in. Okay, so here's our rather ambitious agenda for the next hour, or if we can end a few minutes earlier than that, we will. So in this session, we want to focus on mortgage servicing, and in particular, what legal and regulatory compliance risks you face every day as a servicer, whether you're servicing the loans in-house yourself or whether you're using a sub-servicer to perform the day-to-day tasks for you while you would have management and oversight responsibilities over them. But in addition to talking with you about what the risks are, what to watch out for, we will do more than that. We will make sure that by the end of this session, you can walk away with some real-life examples of what you need to be doing or what can happen if you don't comply, but also some actionable takeaways that you can take back to your organization, discuss with your management team, and implement if they're not already implemented at your company. So here's some of the topics we'll be covering. Again, why this is important, why this matters. What are some of the key areas of risk and trends that are happening right now in 2025 related to servicing, how your organization can strengthen your management and oversight over your servicing function. And as I mentioned, what are some real world examples of things that are going on, either non-compliantly or examples of things that have helped increase compliance and operational efficiency at the same time. And as I mentioned, you'll walk away knowing where you should go next. What's next? And if you have any questions, feel free to put them in the chat. And of course, if you don't think of any right now on the spot, we'll give you contact information at the end so that you can get a hold of us anytime if there's anything you want to talk about. So with that, let's go on to the next slide and get started. Okay, so anytime I do a webinar like this or a training, I know that all of you are taking an hour out of your day to join us. And we appreciate that, and we want to make sure you get a lot out of it. So I always want to start by talking about why the subject matter of this webinar is so important. And so when we talk about mortgage servicing and what your credit union is doing and ought to be doing, it is important in a variety of ways and for a variety of reasons. So number one, legal and regulatory compliance is important not just because it's required by law and you will have regulators coming to look at you. That is important. But it's also important even if that wasn't the case, because it's the right thing to do and it will affect the relationship that you have with your members and your borrowers. The better you perform servicing their loan, the more likely it is that they'll like you and they might want to use other products and services that they with your organization and or refer your credit union to others. So again, that good customer experience is important, in addition to the fact that there are laws and regulations with which you must comply and about which you'll get audited by various different regulators. It's also important because of what would happen if an organization wasn't compliant. There could be a lot of different consequences, and they'd all have one thing in common, which is they're all bad, right? So a non-compliant servicer, whether you're a credit union or anyone else who may be listening, could lead to things such as consumer complaints from your members or borrowers, damage to your reputation. There could be financial consequences as well. And of course, your company could have exposure from an audit or exam perspective and even a legal perspective in a lawsuit. So, but more importantly, let's not focus on the negative. Let's focus on the positive. If you do have a strong compliance program related to servicing, it will support not only long-term operational stability, it'll support efficiency, it will save you money, and prevent you from having to pay out money or all of the other negative consequences. Another way I look at this when I think about servicing and I talk with companies about it is a lot of people think about compliance in terms of originating the loan up front. Well, that process of originating a loan could take 30 days, 60 days, maybe 90. The servicing relationship that you have with one of your members could last up to 30 years, right? Not 30 days, 30 years, which is another good reason to think about how important it is to have a strong infrastructure of compliance to give those members and borrowers a good experience for however many years they are with you. And we're going to talk a lot about how to do that today. So with that, next slide, please. Okay, so let's start right in with when we talk about mortgage servicing. What are some of the top risk areas and areas of focus that we all should be on the lookout for right now in 2025? So what's going on today? So one of the things that led to some of the things that are on this slide is what are regulators and examiners looking for? What have they been focusing on, and what have been common findings during the exams by the NCUA, who regulates many of you, by the CFPB in not only the recent past, they may or may not be out there auditing companies today, but any agencies that are out there, states, for those of you who may be state chartered and have exams, there are regulators out there from all kinds of different entities. What are they finding? Well, a couple of the most common areas of risk that examiners are finding and citing companies for, number one is with the area of loss mitigation. And that comes really in two forms. First is when the applications come in themselves. Are they received and considered timely? And what if that application is incomplete? Are steps being taken to notify the borrower of what's missing, to give them a reasonable time frame to know what they need for that application to become complete? Is that spelled out? And again, are they given that reasonable time frame? And are efforts made to follow up with those borrowers to try to get that incomplete application to be complete? And are those follow-ups happening consistently with all of your members and borrowers who submit an application? Or, for example, might there be one member who gets followed up with 5 times and another one only once, and then you don't hear from them and that application's closed out? Another big area is on the bottom left over there, fees. Fees that are charged and if fees are waived. So for example, what are a couple of things that regulators really don't like? Number one is if there are charges made when the service wasn't actually provided. And we'll talk about this a little bit more later, but an example of that is, for example, property preservation fees. Examiners have seen consistently that there are all kinds of property preservation fees that are charged to a borrower, but no one actually went out and inspected the property. Or fee waivers, another huge area of concern for regulators. If, for example, a borrower is assessed a late fee, what is the policy or practice for waiving that fee? And even more importantly, is that practice followed consistently for all of your members or borrowers? Getting back to loss mitigation again, they're looking at the decisions and the outcomes. Are people in similar situations being treated similarly and receiving similar outcomes? And the prohibition on dual tracking, another important area. If foreclosure, for example, has been started and a loss mitigation application comes in, are those being considered and are borrowers being treated equally? And a couple more areas. Number one is LEP, which stands for limited English proficiency. The more borrowers or members you have, the greater the chances that some of them might fall into that category of limited English proficiency. And how are you handling those members or borrowers when that is the case? Are there some documents that are made available to them in a translated way? Do you have someone who's able to speak with them in the language with which they're more familiar? And again, are borrowers in similar situations being treated similarly? All of that leads to the last point that's on this slide, which is fair servicing. A lot of companies that I speak with know what fair lending is, right? When you're originating a loan up front, when it's the decision to approve or deny, or how to price that loan with interest rate and fees. I think many people are at least familiar with fair lending requirements. Well, fair servicing is in fact a thing. That's a question I get a lot. Is fair servicing a thing? It is. The major federal laws out there, the Fair Housing Act, the Equal Credit Opportunity Act, apply all throughout the mortgage lifecycle. So fair servicing is in fact a thing. And we're going to talk about what that means, including some examples of where inconsistencies or areas where people at your organization may have discretion can lead to potential fair servicing issues. And we'll also talk about how to minimize or eliminate those risks. So these are the top areas that we should be focusing on right now with mortgage servicing. Okay, next slide, please. So when we talk about servicing and your organization and how you can have oversight over your servicing operations, again, whether you're doing it yourselves internally or whether you're using a sub-servicer to help with the day-to-day servicing, either way, your organization needs to make sure there's strong management and oversight of the servicing function. I know from talking with a lot of credit unions, mortgage is only one piece of a large puzzle at your company. And so sometimes there can tend to be a focus on compliance in other areas and maybe not quite as much in mortgage. And further within mortgage, what is the focus that your company has on servicing in particular? So what are some of the challenges that come from the servicing aspect of the mortgage business? So number one, there could be many different regulators that might come out and knock on your door and want to come look. There's obviously the NCUA. There has been the CFPB for larger organizations. We will see. It's yet to be determined what form they will take over the next couple of years, but there will likely be something in the future. There's also agencies, Fannie Mae, Freddie Mac, HUD, and of course, state regulators as well, to the extent that applies to your organization. So when we think about that, how can you be ready to meet those challenges, not only from a regulatory perspective, but to do right by your members? What are some of the challenges that credit unions might have? Some of that could involve there might be smaller teams. There might be not quite enough people to manage the workload of all the loans in your servicing portfolio, particularly if you're attempting to service them all in-house yourselves. One of the things we also find is because of that, there are limited resources or a lot of processes tend to be handled manually. And of course, whenever that happens, that increases the likelihood that something might get missed. The other challenge is the mortgage servicing aspect has high reputational risk. If your member has a bad experience, it might lead to them not wanting to have other services with you that they may have, or not wanting to sign up with you for a bank account, for example, if they're not having a good experience with the servicing of their mortgage loan. Finally, from a compliance perspective, a credit union, of course, just like a bank or an IMB, you're all expected to follow the same laws and regulations, particularly the federal laws and guidelines, the rules with RESPA and TILA, and as I mentioned on the fair servicing side, ECOA and FHA, the Fair Housing Act, all of these different laws and regulations and guidelines, including from agencies, you need to be able to follow them. And from a servicing perspective, again, if the resources are limited, if the team is smaller, that can be a difficult challenge, right? For your company, it could be a reason to want to get help, for example, from third parties that are out there that can help in a variety of different ways, such as with compliance. But the main point is you want to make sure your infrastructure at your organization includes robust compliance policies, procedures, and practices. So with that, let's look at the next slide, please. Okay, so I mentioned at the beginning that we're not just going to talk today about what the laws and regulations and guidelines are, or what you need to be doing or not doing. I want to go beyond that. And I want to actually talk about what we're seeing out there that's actually happening or not happening in mortgage servicing, including with credit unions, so that you can see and understand some examples of what we're talking about when we're talking about challenges with servicing or areas related to compliance that are important for all of you to consider and try to mitigate or eliminate the risks that are associated with these examples. So part of this comes from what we've seen in audits and examinations, what regulators and agencies have told us and have put out there that are common things, common missteps, common examples of non-compliance that they're seeing. This also comes from conversations that I've had with so many different credit unions and lenders, banks, IMBs, anyone making mortgages, conversations about what have your challenges been, what might you have been cited for in an exam or an audit. So all of this is designed to give you some actual examples of things that are happening, right? And things that you want to make sure you don't have that risk of these items happening to your organization, whether it's found in an exam or whether you're notified by a borrower or however the case may be. So one big area, one example is documentation in your servicing file and how you are or are not updating your system when there's communications with a borrower or with a member. And so this can happen in a variety of ways. For example, if a member submits an application for loss mitigation, are you keeping all of those documents and not, for example, asking a member to submit documents to you in order to consider them for a loss mid option, documents that they've already submitted to you previously? Big issue happens a lot. Or are you documenting all of the communications, all the conversations, all the notices you may have sent to that member? And again, that's important for a variety of reasons, including if a loan might ever go the foreclosure route, have all of the notices, documentation been provided, and were they provided timely before you take that action? But long before getting to foreclosure, if a borrower calls and asks a question, or if there might have been a fee assessed and you waived it. Was all of this documented in your file? For many reasons, including one of the requirements for compliance is to have a complete servicing file so that if it's requested by either a regulator or by a borrower as part of a request for information, that you would be able to provide it and provide it timely within that 5 days. So documentation and logging communications, very, very important. The next one right below that is, I would say, one of the most common examples that I see from both regulatory audits and exams and from talking with credit unions and anyone else for that matter. And that is, your policies and procedures might say we do X, right? This is how we handle loss mitigation applications, or this is how we handle managing our escrow accounts, right? Either for the initial analysis, the annual analysis, whatever we're talking about. The policy and procedures will say we do X at our credit union. But then when we look and go underneath that to actually look at what happens day to day, it's not X, right? It's Y. It's either something different or you're not doing everything that your policies and procedures say that you do. That's a big red flag for regulators, but that can also mean problems that you could be notified about by borrowers or in a complaint, for example, or anything else. It's a huge thing. And so one of the things that's really important that, for example, our company helps credit unions and other lenders with all the time is looking at your policies and procedures and comparing them with what your company's actual practice is. So that's something, if you haven't done that, or if you haven't done that on a regular basis, that's something that you're going to want to do. That can be an actual takeaway from this webinar that you'll want to do. You will want to talk to folks who are actually working in escrow or working in payment application, working in loan payoffs, working in any department within your servicing shop to say, what do our policies and procedures say that we do? That's number one. Then number two, what do we actually do? And are those things the same? And if they're not, you want to close those gaps, close those inconsistencies by figuring out, let's say, for example, the way it's actually being done is the best way. Then you would change your policies and procedures to reflect that. Or on the other hand, if your policies and procedures are the best way for you to do it, it's just not being done or not being done in whole, then you want to update what's actually being happening, whether that's training or system enhancements or adding some checklists or job aids or a combination of all of those things so that your policies and procedures at the end of the day match what you're actually doing. Okay, just one more of these maybe by way of example for today, but all 5 of these are good areas for your credit union to focus on to see, are any of these risks present with us today? Or do we not know if any of these risks might be present, which is a good clue to take a look and figure that out. One other example I'll touch on right now is fee waivers and inconsistencies. And so I will give you an example of a company we talked to that, of course, remains nameless. We asked them what your policy is and your practice is related to waiving fees. And we actually asked several different people who were reps that would talk with members on the phone when they call. So one rep said, if a member were to call and say, I know I'm late with my payment, I can make it, can you waive the late fee? That rep said, I would do it for them right over the phone, right? I do it right in the system and immediately that fee would be waived. Then we asked a different rep at that same organization and said, what would you do if a member called and said, they know they're late, they can make the payment, they want the fee waived? That rep said, I don't do it. I don't waive fees ever. And I would tell that member, if they did want to have a fee waived, they'd have to send us something in writing and it would have to go up the chain and they may or may not ever get that fee waived. Then we asked a third rep the same question, what would they do? And they would say, well, I'd waive the fee, but we're only allowed to do it once every 12 months. So I'd have to check and see if it had been done already within the last 12 months. So 3 different reps, the same organization, gave 3 different answers to that question. And what was so interesting about it is all 3 of those employees were 100% convinced that what they were doing was right and what the company's policy was. And obviously, all 3 of them could not be right, right? So one of the things that's very important to think about is you may have a very specific and detailed policy and procedures and practice, but that doesn't necessarily mean that's what's happening across the board. And that example with fee waivers not only brings up inconsistency of practice, it could also present potential fair servicing issues. We're going to talk more about that during this webinar. But what if, for example, that first borrower, that first member who called and immediately got their fee waived, happened to be a white male, right? And the second borrower that did not get their fee waived happened to be a member of one or more minority classes, right? And then whether you had a policy or procedure that was completely neutral or not, that practice could present fair servicing issues. And the question is, how would your organization know if such an issue was presenting itself? And you'd only know if you're looking, if you're examining your actual process versus the procedures and practices that you think you have in place. So again, these are all great examples of actual risks, actual things that have happened, and that you want to make sure you don't have risk of at your credit union. Okay, so next slide, please. So we just talked about some examples of things that could go wrong or that might create risk, either potential or actual risk, if they're happening at your credit union, at your organization. So now that we've touched on that, what can you do about it? How can you strengthen the culture of compliance and the oversight of servicing within your organization? Well, the good news is there's lots of things you can do. And some of the things that you see on this slide, you might be doing, either some of them or all of them, which are great. But these are examples of things that you want to make sure you're doing and that you're updating on a regular basis. Or if there's any of these that you might not be doing at your organization, these can be takeaways that you can take back to your team, to your company's management, and consider implementing, because again, the time and effort that you put in to creating a culture of compliance up front, whatever the resources, time and effort and money that goes into that, I assure you is much less than the time, effort, and resources of money that would be needed if you're not compliant and you get called out on it, either by borrowers or by regulators or by a lawyer in a lawsuit or any or all of those things. So what are some of these examples? The first one is one that we've touched on a bit already, which is to make sure that you have clear and detailed policies, procedures, and actual practices that match what your organization is doing every day, right? Because again, a lot of companies that I talk to, they have very detailed policies and procedures, and they think because of that they're buttoned up. But what they don't know is what's actually going on and how different that might be. So one way to get to that, one way to make sure that your company's policies and procedures match what your folks out on the floor are doing each day is you can add some job aids, some checklists to make sure you're getting the right execution and consistent execution. Let's think about that example that we were just talking about with waiving fees. That is an area where you could have a very simple checklist or job aid that would say, this is what happens if a borrower calls you, a member calls you and requests to have their fee waived, right? Step by step to make sure each rep, no matter who it is, follows the same procedures and does the same thing. So every member that calls about this issue gets the same result. And another way to do that is to see what we just talked about, the job aids and the checklist. That can be an upfront, preventative, proactive measure. Those are always the best, in my view, as a way to get 100% compliance. But another thing you can do is look at what happened afterwards, meaning past tense, what happened with our loans. And so whether that's phone calls or emails that a borrower might send, or text exchanges between a member and someone at your organization, you can take a look at some of those. You can take a look at a sample, or depending how many they are, can drive how many you look at. That will help clue you into, okay, what actually happened, right? We have policies, we have procedures, we have system controls, we put job aids and checklists out there for our employees to use. We did all of that, so we think we're buttoned up. But then what you want to do is you want to look and see what actually happened, right? Listen to some calls. Look at some email exchanges or text exchanges, if there is texting going on between your employees and a member, to see what actually happened, right? Did the policies, the procedures, your practices, your job aids, did they work? Are all of your different employees doing the same thing for your members? Another thing you can look at are data and reports. Let's use loss mitigation applications as an example. As we know, once a loss mitigation application is complete, there needs to be a decision made within 30 days. That's something that you could create reporting about. Is that actually happening? Or, for example, are the applications themselves being acknowledged within the 5 days of receipt as either complete or incomplete? And if they're incomplete, did that letter go out that says what's missing? And was that reasonable time frame provided for the missing documents to be provided, so that the application can go from incomplete to complete, so that member could be considered for a loss mitigation option or any options for which they might qualify? You can have data and reporting that can identify gaps. It can also identify training opportunities and or maybe system enhancements that your organization might need, or a checklist or job aid that could be added, or maybe adding a step to your procedures, or a combination of all of those things. So again, another action item or takeaway that you can take from today is, do you have data and reporting on all the different aspects and processes within your servicing organization, within your operations? And if you don't, there's opportunities to add some data and reporting elements to what you do to help you manage your portfolio. Definitely something, if any of you have any questions or want to know how to get started with that, feel free to contact me. Would love to talk to you about it, and we'll have some information about that at the end. And also, we mentioned fair servicing already during this webinar. You want to make sure that there is consistent treatment for your members, for your borrowers at each stage of the servicing process. So, for example, turning incomplete loss mitigation applications to complete ones, or once complete, the decisions that are made to approve or deny members for a loss mitigation option or options. If you have borrowers that their credit profiles and histories are similar, they should be getting similar results if they're both delinquent and applying for loss mitigation. What you want to know is what is actually happening? And again, I mentioned fee waivers. Are borrowers who want fees waived, are they getting similar results when they ask? And so, to sum all of that up, when thinking about how to strengthen your oversight of your servicing operations, you'll want to make sure you're prioritizing consistency and making sure your policies and procedures and practices are clear so that your employees know what to do. I have found, I've talked to so many different companies that service loans, they all have one thing in common. Every employee wants to do the right thing. Everyone does. They only need one thing in order to do that. And that is they need to know what the right thing to do is. And if you can help provide that, then your employees are going to do the right thing. And the state of your oversight and management of your servicing operations will be strong. So with that, let's go to the next slide, please. Okay, so we have spent a lot of time this morning talking about, number one, what all goes into mortgage servicing, in particular related to legal and regulatory compliance. We've talked about the various laws out there at the federal level, the agency level, even the state level. Any of you who've had loans in your portfolio who've gone through the foreclosure process, if you're in any way regulated, for example, as a state credit union or anyone regulated by state examiners, knows, particularly in the foreclosure realm, how many differences there are from one state to the next in the foreclosure process. That even carries over to the loss mitigation process as well. There can be different rules or requirements at the state level, in addition to many different requirements at the federal level. We've talked about what some of those things are, and we've talked about how your organization needs to have a strong culture of compliance. And that includes, again, policies, procedures, system controls, job aids and checklists, training, so many different aspects that can help your organization be prepared to help your members have a great experience during the perhaps decades that you will have a relationship with them while you're servicing their mortgage loan. And again, I want to emphasize, the better their relationship is with you in the servicing of their loan, the more likely that member is to want to utilize your credit union for more services or to keep the other services with your credit union that they already have. So to that end, I wanted to provide a few actual real world examples of solutions that we've seen from credit unions that have made a difference. Again, it's really important to me that all of you walk away not just with some knowledge, hopefully, but with some actual takeaways that you can take back to your organization. So here's a few examples. Number one, a credit union that we worked with, we're having a lot of delays with loss mitigation applications in both realms. Either when they came in incomplete, the process of trying to look at them and get that letter out and try to get those applications complete, and or the process once complete of getting those loans reviewed, those applications reviewed within the 30 days to make a decision for that member, for that borrower. So what they didn't have, what that credit union didn't have, was an actual checklist about here's all of the things that we need in order to have an application that's complete and to be able to get that application considered for loss mit and get that decision made. And by adding that checklist, it was standardized, and everyone at their credit union who would work in loss mit had this checklist. And it was a huge help in not only knowing what to do when an application first comes in, or even when a member's on the phone saying, I think I might be falling behind, can you send me an application? From that moment, all the way through the decision that's made, whether it's approved or denied, whether there's an appeal of a denial, and anywhere in between, that credit union reduced their delays specifically because all of their employees knew step by step what to do, what they needed from a borrower, what to do if something was missing, and what to do once everything was received and that application is complete. Was a huge help. Okay, example number two. One credit union was having difficulty with their borrower experience. They were finding that borrowers, whether it was not getting their calls answered or not getting them answered timely, or once they were having a conversation, those conversations weren't going well. And the data and reporting or listening to calls, the call monitoring was showing that credit union that. And so what that company did is they added a quality assurance framework, right? And so that included some checklists and job aids that they added up front so that their employees would know what makes a successful call with a member or what might be some pitfalls that would make a call go sideways or go south. But then also, they developed a framework and a process for reviewing calls after they happen, right? No matter how good your processes, your procedures, your job aids might be upfront, you still want to be able to look at and review and listen to calls after they happened, because it's the only way you'll know if those things were followed, right? Or if there were any issues. Did an employee forget to do something? Or did the call end up going sideways? Was there yelling? Was there a tone that was not what you want or not reflective of your organization? By adding that framework, what did that credit union get? Feedback. They got feedback about themselves and how those calls were going. And that feedback led them to a variety of solutions. Individual feedback for employees, training ideas for everyone, what they could maybe add to a job aid or a checklist. So as you can see, just by taking a step of looking, there could be a variety of solutions that could present themselves to you to take however great your organization is, which I'm sure it is, and make it even greater. Third example, there was a credit union that obviously many of the loans in their portfolio had escrow accounts set up for their members for property taxes and insurance. So with that comes requirements to perform escrow analyses, right? Upfront, the initial one, and the annual escrow analysis. And of course, part of that is to determine if there might be a surplus in the member's escrow account or a shortage of funds that are needed in that member's escrow account. And as we know, if there's a surplus or a shortage, action steps need to be taken when that happens to correct that, especially, of course, if there's that shortage, to work out with the member how that member will get to the amount that they need for those taxes and the insurance premiums. So what the credit union found was they did not have good reporting for all of their loans that had escrow accounts set up. So if the question were to be asked of them, for all of your loans in your portfolio that you're servicing that have escrow accounts, for the ones where it applies, have you performed the annual escrow analysis in a timely manner for all of those loans? The answer from that credit union where they started was, I don't know, right? Which, as I'm sure we'd all agree, can be one of the worst answers to a question, especially when there are regulatory requirements involved. You don't want to be in the place where you don't know if you're complying or not, right? That brings you to the category of unknowable risk, right? At least if there's risk that you know about, you can take steps to correct that or mitigate that or hopefully eliminate it. But if you don't know what your risk is, that's the worst place to be, right? So what the credit union did, of course, was completely revamp their process for escrow in terms of how it's administered, and importantly, adding detailed reporting for all of their loans that have escrow accounts set up, including when was the initial analysis performed? When was the most recent annual escrow analysis performed? What's the date the next one needs to be performed by? And that reporting can be generated and then reviewed and managed. So that would then notify the credit union of what's coming up, or if there might be any loans where it was missed, so that it can be corrected and improved that organization's compliance. And not only that, but the effectiveness of those loans with the members and making sure there were sufficient funds in those escrow accounts or dealing with surpluses when that happens. It made them much more effective in how they were servicing loans for their borrowers, and of course, greatly improved their members' experiences. And that's a really big point that I want to leave with all of you related to this, which is when you implement solutions to further enhance and increase your level of compliance, you get a host of other benefits at the same time. Number one, it adds operational efficiency. Number two, it adds to the good experience that your members will have, which again can lead to them keeping other products with you or getting other products with you because they're having such a good experience. It can lead them to refer your organization to others. And of course, it will save you time, effort, money, both in terms of the cost to service loans and money saved because you won't be paying regulatory fines or having to get outside counsel to help you or any of those things. So the more you can strengthen your infrastructure and culture of compliance, it is a multifaceted selection of benefits that your company will reap from doing that. Okay, next slide, please. So now that we've talked about everything that we have so far in this webinar, again, what laws and rules and regulations are out there, right? Why is it so important to focus on compliance, particularly related to mortgage servicing? What are some of the key areas of risks or areas of focus for members, for regulators, agencies, anyone down the line? And for example, we talked about instances where things have gone wrong, so you can see examples of what those are. We've talked about what are improvements or examples of improvements or enhancements that you can make. So I want to pick up from there and say, where should you go next? Again, what are some actionable steps that you can take from this webinar today? Well, we've listed a few of them for you. So number one, are all of the employees on your teams, as part of the training that they receive, does that include how to identify issues or gaps? And if they do, how and to whom to escalate those issues? Because, for example, if a problem is identified with one or two loans, what you want to do, hopefully, is prevent that from being an issue more broadly, right? Or with all of your loans. And one way to do that is as soon as someone identifies an issue, to escalate that issue to the right person or department. And I mentioned LEP earlier, the borrowers with limited English proficiency. It continues to be a big area of focus for regulators, and that will only get more so in the future. So are your LEP borrowers receiving consistent support, documentation? Is there someone available, if possible, to speak with them in their native language? What is your focus on LEP? Another topic we mentioned was fair servicing. Do you have specific policies and practices defined to mitigate or eliminate the risks of fair servicing issues, such as with fees and waivers and loss mitigation applications? Or is it more you're assuming that we wouldn't ever discriminate against anyone? And again, that's part of the point. It can happen. Fair servicing issues can present themselves even if there wasn't an intent to discriminate. And again, this is a really important point. Do your policies and procedures match what is actually happening day to day at your organization? We see this all the time. A company might have great, detailed, and specific policies and procedures, but what happens day to day with their employees is not that. Or maybe some of their employees are following it and some are not because they're doing something different, either because that's what they thought the right thing is, or maybe that's what they did at the place they worked before they came to your company, or maybe the company's policies and procedures changed and someone's still working off the last version, right? Not the most current version. Finally, when you think about your entire compliance infrastructure, every aspect of servicing, and thinking about managing risk from a legal and compliance perspective, is your infrastructure built to evolve? And when I say evolve, the one thing we know that is certain in compliance related to mortgage, and especially with servicing, is that things are not certain always, right? The only thing that's consistent is that things change and are not the same always. And so, as part of your compliance infrastructure, you want to make sure that you have a process for change management, right? Implementing changes when there's either new laws or regulations or differences or changes to existing laws and regulations, or if there might be changes to the types of loans that you're servicing in your portfolio. So it could be business model changes that might lead to changes you'll need to implement at your organization. So as you're thinking about what you have in place today or what you might want to add, especially based on some of the things we've talked about over the last almost an hour, are you able to be nimble and dynamic and evolve to not only be compliant right now, but to be compliant for the next thing and the next thing after that? Okay, next slide, please. So, with that, what is next? Meaning we're about at the end of our time together today. So, what's next? Where can you go from here? What are a couple of things you can do right away, right? We talked about a lot of things that you can do or you might want to implement or change that could take some time. Well, what are some things you could do first, right away? Well, the first thing is starting you off with some good news. All of you who are attending and who registered for this webinar today will receive a copy of this presentation. So you'll all have it. So one of the things you could do is take some time to go over this presentation again and reflect on it and think about what stands out to you as maybe things you want to take a look at your organization, or what questions might this presentation have raised for you or your company. Secondly, do any of the risk areas that we identified and discussed today apply to your current operations? Or even more importantly, are there any of those areas where you're not sure if the risk might apply either potentially or actually at your organization? And you can use all of that reflection to start a conversation with your management team. That conversation could, for example, include all of the different areas where you think your company's solid, but you still might want to check, or what areas where you think there might be opportunities for improvement or enhancement, which is a good lead into the next slide, which I also believe is the final slide for today, which is if at any point today, next week, next month, if at any point you have any questions about anything we went over today, anything you see in this PowerPoint, anything that's going on at your organization in any way related to compliance or risk or audit, if there's anything you want to talk about with someone or have questions or things, ideas you want to bounce off, please feel free to contact me anytime. Again, you'll get this presentation. It has all of my contact information on it, all of MQMR's contact information on it. And please follow up with me. Would be happy to have a conversation with you to delve into any or all of this further. There's additional resources that we could provide you. So again, feel free to reach out to me anytime. Would love to talk with you, help get your questions answered. And with that, I will say thank you so much for joining. I know what it means to take an hour out of your day. Hopefully you found the information helpful and got some actionable steps that you can take going forward. So thanks again. I hope you have a great rest of your day.